Well, investment philosophy is driven by asset allocation, incorporating elements of behavioural finance. Absa Wealth manages personalised discretionary portfolios for clients using both active and passive strategies. Philip Bradford, Chief Investment Officer at Absa Wealth, joins us in studio to share their various investment strategies being employed at the moment. And one of them, if we go straight to global asset allocation, is that you see long-term value in both developed market equities and emerging market equities. Can you explain that strategy, please?
Definitely, Bronwyn. I think importantly, there's two different stories there as well. Emerging markets obviously have the long-term growth story for us. That's where we're likely to see the growth coming from in the future. Importantly, you can get exposure to those markets, though often through developed market stocks. But particularly the attractive play at the moment, as you've been discussing earlier as well, are developed market equities. Europe is extremely attractive, although there's risk there. The American stocks, even though they have moved up this year and over the last year or so, are still looking attractive. And the key thing there in those markets is interest rates are extremely low, and the demand for anything that gives you a higher yield than government bonds is likely to persist into the future. And
that's why I'm 100% equity.
That's no asset diversification or allocation.
No, I diversify my portfolio.
Yes, we know, among companies.
But why must you go into a bond? US bond or any bond?
Well, I think Philip agrees with you on that.
Well, I think the key here is not to have zero bonds, and again, it depends on each investor, and that's why we incorporate a lot of behavioural finance into it, because everyone's different. Your risk profile could be hugely different to someone else's. Someone else who may be less of an expert in equities might want some sort of protection in the portfolio. And we've discussed it before. What is that protection going to be when you're looking at the global markets? Is it going to be gold? No, because we've seen how that can fall when even when markets are falling. But what we have seen hold up very, very strongly are particularly US dollar treasuries. They are I saw the quote earlier actually, they call them the best of the dirty shirts in a way. And in an event of a global crisis, you are likely to see that hold up. In fact, we about a month or so ago, on a global basis, we moved on to a tactical view of actually slightly reducing our weight to global developed market equities in favour of cash
bonds, but
and developed market bonds.
But there we go.
This is where I'll challenge Philip. Go have a look at Microsoft's balance sheet. 50 billion of cash on their balance sheet, a product that we all use. Would you rather have that balance sheet or the US Treasury balance sheet?
Well, I think in the situation, if the
you understand what I'm saying.
But if the euro crisis ends badly, you want the US balance sheet.
But then you're not assured of the fact that the US is not going to end badly.
Correct. And
the economic data out of the US is very patchy at the moment.
Very importantly, last year was a great example where everyone was short developed market bonds. And don't get me wrong, as a long-term investor, there's no ways they're a safe place to invest. With the yields as low as they are, the duration is very high. You've got a very small movements in interest rates cause big capital gains and big capital losses. But in an insurance situation, they still can provide you with some protection. What we've been looking to do on the global side is look to introduce bonds that are probably more short duration, and particularly on the higher yielding side. In the short term, we took a small bit of weighting off on emerging market bonds and higher yielding bonds, and a little bit of equities, just until we could see what's going to play out with the Greek election, and we still haven't seen resolution to exactly what's going to happen there.
So you think, just to cut through all this, you think that Greece, Eurozone, it's all going to end badly? Going to be tears?
The likely scenario is that we are likely to go through that, but what are those odds? You know, if it's a 9 out of 10 chance or a 90% chance that it's going to end well, that's still a 10% chance that things can end badly. But looking through that, though, as long-term investors, we are not invested in economies, we're not invested in GDP or the Eurozone, we're invested in companies. And
which
companies
to David's point.
So companies are extremely attractive, and I think even on the local side, we are driven by what happens globally. You were talking about Sasol earlier.
Tell me that you're one of those also that holds Sasol in high regard. 339 Rand you are accumulating aggressively.
Well, correct, but the reason that Sasol is continuing to fall is because it's probably expensive almost relative to some of its global peers. So that's a global play. Sasol's a global stock and it will get sold off. Our bonds are driven. Most people have been struggling to buy local property and bonds for the last year or two, and you would have been wrong if you hadn't have been holding them. Property's been extremely strong. Just over a year ago, we changed our 5-year asset allocation view. We reduced our bond weighting slightly, and we favoured cash and property. Now that has paid off very, very well for us because
I want to get David in here on the property side because I spoke to Mariette Warner from Absa Wealth also on the property side, and it's a good play. It has been for 10 years.
And it's one thing, and I really like our property managers. I think they do an excellent job. It's a one sector that I would invest in. And what's interesting, even paying full tax on the the receipt that you get, and it's not dividends, it's income, you pay full tax. Even so, it's far better to hold property. You still make good capital profits and your total return is still very good. So I'm very positive on property.
So what we've seen in a global low yield environment, which we see is probably likely to persist for years to come, it makes emerging market assets like ours very attractive, particularly our bonds and property to a large extent as well. The great thing about property, I've often found, has been more of an asset allocation person. I've looked at property very seriously, but I find property falls between the cracks. Bond managers don't really look at it because it's not really their space. Equity managers often ignore it as well because it's not quite equity.
But ignore it at their peril, given their the past performance.
So if you're looking at a yield, even if it's some of them the stocks are trading around 6 or 7% at the moment, it's not a bad yield, but you've got the capital growth element which tends to come through in the rental growth, which you don't get out of bonds. So in the environment, and I think again, just to reiterate the point, is that we need to look globally to understand what probably is going to drive our markets.
You have said, even though we're looking globally, I want to come to the local side, and you're saying that there are pockets of value in certain sectors. Now, are you saying resources are one of those pockets of value?
Well, I think importantly, whenever you invest in value, there's a risk, and you require an extra premium for taking that. And I think particularly right now, the resources are those kinds of value stocks where they should do well in the long run, but we know that their earnings can disappear quite quickly because we're very much driven by what goes on the macro environment. The oil price or the rand dollar exchange rate are probably the two primary drivers of Sasol's earnings. So yes, they are showing value. And I think what we need to do though, as I think it was John Templeton who said that you invest when there's blood on the streets. And if we look at Europe at the moment, even if you look at some of the banks globally, as much as they're in trouble, we know that in the short term we might struggle, but in the long run as an investor, you should see great rewards.
He said invest at the maximum point of pessimism.
And the same thing when Buffett, I always quote him, says when buy when others are fearful and sell when others are greedy.
Just on the resource side, be careful. Why I like Kumba is that even if the iron ore price comes down to 100, their margin, they're still making a 60–70% margin. So they're still generating huge amount of cash to pay dividends.
This is interesting coming from you because you're such a resource bull.
I am a resource bull.
So for you to say be careful.
No, I'm saying be careful of gold or platinum or some of the other plays. Make sure that the companies that you invest in have very wide margins. Exxaro, Kumba,
What about your diversifieds? Anglos, BHP? Billiton is your play.
Billiton's a play, yeah. Okay. Mainly because of where their focus is, which is mainly iron ore, coal, oil.
So my question was value, pockets of value. Where else do you see pockets of value in the South African
definitely
space?
on the resources side in South Africa. It's hard to ignore the fact that earnings are still coming through quite strongly on some of those retailers. So someone like Mr. Price, the price earnings ratio is a very poor indicator of short-term performance, a very good indicator of long-term performance. So I think we need to be aware, as David correctly pointed out, that if you are going to invest in these cheap resource companies, you could in the short term show some losses, but in the long run you're likely to see some good rewards.
What about construction, gentlemen? Is that cheap?
Now that's a good equivalent of a value trap, I think, where it's unlikely to see those earnings turn around in the short term.
Are you still
it's not coming
not
through.
Convinced on
it's
the
not,
construction
if
side?
you looked at the Reserve Bank quarterly, you'll see the spend is not there. And until we start to see the physical cash going into those projects, I say avoid, just pull back. I would rather go into retailers. I mean, if you look at Foschini's forecast, they're still forecasting 20% growth. If you look at Mr. Price, they're still forecasting that growth. So I would rather go for companies like that than try and look for that.
Would you still really buy retailers at current levels, David?
I think we've got it wrong.
Do you think so?
I think we've got it
I think you've just got quite a good sight of their earnings. You know, we can, they're much simpler companies. We can see people spending, we can see wage negotiations coming through. We can see people spending their money. Where with a resources company, you are very much reliant on what's happening in the global environment. You're like a cork bobbing in the ocean.
Exactly.
You're not too sure.
You're subject to all these external elements and you really don't know which way they're going to swing at
But
the
there are a
moment.
lot of, I've been impressed with the results. Look at Omnia yesterday, great results. Even Naspers. I mean, look carefully at that. I would prefer to have Tencent than Facebook. And I think that it's a company we underestimate. So there are still good results on the local market that one can go for, you know, without having to dig deep for so-called value.